joins us now. He's the CFO of ING. Tanate, thank you very much indeed for joining us. Well, look, a lot of people in your business have been hoping for higher interest rates for a long time. Now they are here. What is it doing to the business model? Good morning, sir.
Hi, good morning. Very nice to be on your show. I think we are very confident about the performance that we had in Q3. And that if you take out some one or two incidental items, our net interest income is rising, and it's rising for the very reason you mentioned. It's rising on the back of sharply higher interest rate curve that we see in the Eurozone. And so our year-on-year underlying net interest income is up about 8% year-on-year. So that's what we see in our results today. Apart from that, to give you a bit of other line items that we have, fee income remains resilient despite what we see in the capital markets, and that our costs are under control. But I think the most important thing that we see is that our loan portfolio remains resilient with low non-performing loan ratio, I think one of the lowest in the Eurozone at 1.3%.
Yeah, you preempted my next question as well. It was the loan quality in a rising rate environment that I and many have great concerns about. So you're keeping that under control. That's your job, especially as the CFO as well. Any warning signs there, though, for your company and indeed the broader industry?
Well, I think if you look at the this particular coming recession, and we do predict a recession, somewhat milder in our home market of the Netherlands and a bit more sharp in Germany. But I think you have to put that into the context that this recession is happening where employment remains very tight, right? If you look at vacancy rates, that remains very high. And I think that bodes well, particularly in the retail banking sector where unemployment level drives a bit loan loss performance. So I think we will have a recession, but it should be a mild one given that vacancies are low.